Hey everybody, it's Mike from Order Flows and welcome to today's presentation on order flow nuances and techniques to improve your trading. My name is Michael Valtos. I'm the founder and trader at orderflows.com. So, you know, to start off this presentation today, I want to ask you, what is your edge in the market? Do you have one? Because today I'm going to share mine with you. And what you're going to learn in today's presentation is how to trade order flow the way institutions do, how to get the maximum out of order flow delta, how to see market imbalances in ways other traders miss. And lastly, I'm going to talk about how to determine short-term value and how to trade it. Hopefully, it'll take only about 45 minutes, but I know some of the stuff is a little bit in depth, so it might take a little bit longer. So I appreciate your patience and understanding. So those that are new to my presentation, let me just explain who I am so you can understand where this information is coming from and why it's relevant. So my name is Michael Valtos, and for the last 5 years, I've been the owner and trader at orderflows.com. It's a company that I started after leaving JP Morgan. I spent 8 years at JP Morgan as vice president of futures trading on the trading desk. I wasn't sitting in a corner office watching people's P&L and come over and tapping them on the shoulder saying, hey, you know what, you're trading outside your limits. No, I was the one there banging away on the computer, since it's all computerized, doing the trading myself. Prior to that, I spent 4 years at Cargill, also doing the same role, but more of trading desk manager, where I had a team of traders that I was managing as well as doing the trading. And prior to that, I was with Commerzbank in Chicago as a licensed Eurex trader. So I traded bunds, bobbles, shats. At that time, that was back around 1998, 99, 2000. That was, I was one of the only of about 3 or 4 people in the United States that was able to trade bunds, bobbles, shats, DAX, Euro stocks on the Eurex terminal itself. Because there was, when Eurex came to Chicago, a lot of the traders on the board of trade started complaining that, hey, you know what, you're taking away our market share. But I got in at the time when, I sort of grandfathered in under that under the company Commerzbank. And prior to that, EDF Man, the global macro trader, the big English company. I spent 2 years there on the macro trading desk, and I started on the CME floor back in the early 90s. And eventually I left the trading floor when I realized, electronic trading was going to be the future of trading. And I joined the Globex trading desk. That was the electronic trading desk for after hours. I literally worked from 10 p.m. until 9 a.m. trading the electronic markets. We didn't deal with the floor markets so much. In Europe, they were still trading the floor markets. In Asia, still trading on the floor. But, our main focus was providing liquidity on the electronic markets at night. So, what I'll be talking about today is, what I've learned over 25 years of trading electronics at the highest level. In 2013, I left JP Morgan to spend more time with my family. What is the point of trading if you don't have the freedom? And working at JP Morgan, I didn't feel I had that freedom anymore. I was literally tied to my desk. I would come in at 6 in the morning and leave at 5 p.m. at night. I was spending more time with my work colleagues than I was with my family. So I decided I got to do something. I got to make a change. So I left JP Morgan to trade for myself, and I wanted to write a book on trading, sort of give back things that I've learned over the years. And I ended up writing this 150-page book. And if you stick around to the end, I'm going to show you how you get a copy of that book for free. You could download it. It's not going to be the hard copy. You're going to get a PDF that you can print out and read, or just read it off your phone or computer. But like I said, in 2013, after leaving JP Morgan, I was trading for myself. I was trading with order flow on what I already knew about the markets and order flow and reading the order flow. And the software that was out there, I wasn't pleased with, in the sense that it was very basic. So I sat down with the programmer around 2014, and I said, hey, you know what? This is how I look at order flow. This is what's important to me in the order flow. And can you put that into the software? Okay. So I did that and I started using it myself. And, I was sharing it with some people, and people were like, hey, this is great. You should think about selling it. And, I held off and I held off. And, since it was created for NinjaTrader, the guys at NinjaTrader, back in those days, you had the ecosystem in a different form that it is now. I got on the ecosystem, and a lot of other traders really liked my software. Okay, and what it is it's a volume footprint chart with 7 pre-programmed order flow indicators already there, right? So you don't have to sit there scratching your head. What does this mean? What does this mean in the order flow? What happens when this occurs? It's already there. It'll highlight to you things that are happening in the order flow. And the reason I just talk about this is because I want you to understand the charts that you're going to see in this presentation are generated from that software, and it runs on NinjaTrader 8. But before I jump in, brief disclaimer, please understand that trading involves risk. Right, so only risk capital that should be used for trading, and only those with sufficient risk capital should consider trading. Don't trade with your rent money, so to speak. So the first thing I want to talk about is how to trade with order flow the way the institutions do. Okay, and when most traders think of the institutions, you just think of the big bankers, right? What's JP Morgan doing? What's Goldman Sachs doing? And that's all well and good. You got to follow the money in the market. This is just, a couple weeks ago, Goldman Sachs, their earnings on trading, bond trading revenue surged 150% to 4.2 billion, equities trading 2.94 billion. So, JP Morgan also bond trade has posted a revenue of 7.3 billion, which is 120% increase from the year before. Equity traders posted revenue of 2.4 billion. The hedge funds got hundreds of billions, thousands, what was this, trillions here under assets under management. So the part that a lot of people forget about are the big oil trading companies, the big commodity trading companies. And I spent 6 or 7 years, at those type of companies, at Cargill, at EDF. Man, they have a very big footprint in the market, as big as, if not even bigger than the banks. And a lot of traders, retail traders, don't really understand, who these people are. Vitol is one of the biggest oil trading companies in the world. Just this year, they're paying $6 million to the top employees. Like 300 people got over $6 million in bonuses. Gunvor, which is also a big commodity trading company, they're posting, almost like record profits this past year. And you could just run down the list. Here's a list of a lot of these companies: Vitol, Glencore, Cargill, Koch, ADM, Gunvor, Trafigura, Mercuria, Noble, Louis Dreyfus, Bunge, Wilmar. You never hear of these companies, but these are very big companies, and they control literally the supply chain of many commodities. Most of us that are in trading, we just understand what's the S&P doing, what's the Dow doing. But you got to look at, there's crude oil, there's corn, there's soybeans, there's palm oil. There's so many different commodities out there besides just trading mini S&Ps or mini NASDAQ. So once you understand that there's so many big players in so many different markets, you got to understand that you can't see who is buying or who is selling. You don't know if they're getting long or getting short, right? But you have to focus on what you can see: big orders being traded in the market. So, the volume footprint chart, in my opinion, is the best for seeing what the big boys are doing, right? This is gold yesterday. Gold is the new Bitcoin now. It seems ironic to say that, but gold has been on a tear for the last several months. And this is just yesterday. So this is a quick 30-second chart. And you can see right up here at this swing high, you got a big order sitting up there, resting liquidity, so to speak. 102 contracts trade there. What happens? Market sells off. Okay. Now you don't have to know who that 102 contracts is. You don't have to know if it's getting in or getting out of position. What you have to know is, hey, there's 102 contracts up there. That's enough to stop this move up and push it back down. Okay. Because what happens as the market's rallying up, it hits a resistance level. Then when you hit that resistance level, can't break past it, what happens? Traders all of a sudden that were buying on the way up know that there's resistance up there. They're going to turn around, start selling it. Market's going to sell off. Okay, so again, this is gold on a 30-second chart. 102 contracts is considered big. You got to understand, what's considered big size for your market. And this is a nice move from 2074 down to 2071. In a matter of 3 minutes. Here's another. Yesterday, again, in the gold, boom, we hit the low. Trade 203 contracts, 2 ticks off the low. You do get past it. You trade 10 lots right below it, trade another one right below it, but then you can't come back down to it. People recognize that there is a big buyer down there, okay? And once you recognize that, once you recognize where there's active buyers or active sellers in the market for big size, then there's a big participant there who thinks the price is cheap at this price. On the previous example, there's a big seller up there who thinks price is expensive up there, okay? And so, you can see how in the order flow, the market is generating support and resistance levels. Okay, this is market generated information at its best, and you could react to this as soon as it happens, right? You're not looking at a chart 10 minutes later saying, oh, this is here. As you're trading it during the trading day, you can see, hey, well, there's a big buyer there. That someone just scooped up 203 contracts there. Okay, there's some absorption or there's some distribution going on, and react to it instantly. That's where the power of order flow comes in, right? Is recognizing what the other big players are doing. And there's this common misconception of size in the market. You know, uh, uh, if you're a big trader, okay, now I'm just speaking from my own experience working for big companies, trading big size in the markets. If you're a big trader, okay, and you got a big order, right, you don't want to move the market. Okay, that's just how it works, right? Because you know that if you're buying, okay, say you got 1,000 contracts to buy here at 2025, which is what this order was, buying, probably 200 there. Okay, you don't show the whole. I mean, you can show the whole 200. Most likely you're going to iceberg it, show 10, 20 at a time. And on most trading systems, on the professional trading systems, there's a function, it's called an iceberg, right? So you just put in your iceberg order, you hide the size, you put your order in, buy 200, show 10. Okay, and it just automatically reloads. So as the market's coming down, right, people are selling into that. They think, oh my gosh, we just broke 25. Let's sell some. Okay, but then the order keeps reloading. Okay, so they're not the big buyers there. He's absorbing all the selling, right? People are selling, oh, sell it. But the guy is just there sitting back. Yeah, I'll buy whatever you guys got. But if he were to show his full size, 200 contracts, the market might come down to 20, 25. Then traders will start noticing it in the order book, and they might react off of it and say, "Oh my God, I don't want to be selling down here because there's a big buyer here." Okay, so the market may not make that move, but when you see this traded in the market, that's the beauty of looking at a footprint chart, is because every trade that goes through the exchange gets posted instantly. So you're going to see it show up in the volume. So once that volume trades, you know that there was a big buyer there. And this is different than, say, looking at a dome or looking at um, a book map. Book maps and domes do have their place in trading, but what's more important? Actual liquidity that traded in the market, as opposed to resting liquidity that is just there, that is acting sort of as a moving goalpost. Okay, once someone commits themselves to the market, once someone buys 200 contracts and is filled at on 200, they got a position on, and that's different than someone that's trying to buy 200, half a buck lower, right? That the mentality is different when you have a position on as opposed to when you don't. It's just like trading with, real money as opposed to sim. There's a different mentality. I would love to buy here at 2024 and a half. I'll put 1,000 lots in there, but if the market's not going to go there, it doesn't mean anything. But when the 200 lots trade at 2025, it means something, especially when the market reacts off of it. Now, like I said, the volume footprint chart is the best, in my opinion, for seeing what the big boys are doing, because you can see the volume that is being traded. And as much as the big boys want to remain hidden in the background, they cannot hide what they actually trade in the market. Because like I said, once they trade in the market on the screen, it shows up there for everybody to see. So knowing where and when the big traders are active in the market gives you insight into the market other traders just don't have. If you're looking at a normal bar chart, you're not going to see the volume that's being traded. And the volume plays an important role. As much as a lot of people like to discount the volume, it does matter. Think about it, right? If you've ever run a business, a brick and mortar business selling anything, you're going to check your sales numbers, right? You don't just check what you sell at a price. You're going to check what you sell, the quantity at a price. Say you sell jackets, okay? You price it a certain price, right? And then you raise the price as demand comes in. It gets to a certain point where there's no more demand because your price is so high, so you got to start lowering the price. So you check, the quantity that you sell at each price, and it's the same thing in the market. Now, the next part that I want to talk about is getting the maximum out of order flow delta. Now, we're all familiar with the trading dome, right? It shows, the market depth to the upside, to the downside, and where the current bid offer is. But order flow is really about understanding what the aggressive traders are doing in the market. And what is an aggressive trader? It's someone that crosses the bid offer to trade. So in this case, here's the S&Ps. It's 39 bid at 39 and a quarter. Okay, size of 78 by 98. And then below it, you got bids at 38 and 3/4, 38 and a half. Above, you got offers at 39 and a half, 39.75. So people that are sitting on the bid are what you call passive buyers. People sitting on the offer are what you call passive sellers. So for a trade to happen, a passive buyer has to become aggressive, right? They have to cross the bid offer line. They have to go from 33.39 to pay the offer at 39 and a quarter. That's what you call an aggressive buyer. For someone to be considered an aggressive seller, they have to move their offer down from 39 and a quarter to 39, right? They are aggressively selling. And think of it like this. If you're out, if you're buying a house, okay, you see a house you like, it's $250,000, but you're like, it needs a new paint job, it needs a new driveway. I'll give you $235,000. Well, the buyer's like, well, I'm just trying to sell it at 250,000. So you're not going to get a trade done, right? You want to pay 235. The guy wants to sell it at 235. One of you is going to have to get aggressive. You're either going to have to raise your bid, or the seller is going to have to lower his offer and hit your bid. But if the seller's like, oh my gosh, I gotta sell this house. Okay, fine, I'll sell it to you at 235. Then the house seller is the aggressive seller, right? Because he's moving down his offer, he's hitting your bid, because he wants to unload the house, he wants to get it off his hands. Now, if you're like, oh my gosh, my wife really likes this house, but I don't want to tell him, so I'll just say, okay, I'll buy your house, 250K, I'll pay cash, right? So you become the aggressive buyer. So when you really want to get a transaction done, you become aggressive. So you're either going to become an aggressive seller or an aggressive buyer. Now, order flow delta is a net difference between aggressive buyer and aggressive sellers in a bar. And just about all order flow traders look at delta. It's one of the main cornerstones of order flow is the delta information, because they want to know who is in control of the market. But within order flow delta, there are different measures of delta a trader can use to understand what's happening in the market right now. So there's the delta, okay? There's the max delta, min delta, and there's cumulative delta. So there's actually, within delta, there's additional subsets of data. So delta is the most commonly used delta. It's sort of like the headline number. It's going to give you a quick determination of who's in control, aggressive buyers or aggressive sellers. All right, so on a footprint chart, generally it'll appear at the bottom. Some people got their own software that will print it above or below a chart, but I think it's best along the bottom, because you want to know where it is at any given point in time, and it's just easier to keep it there. But it gives you a quick determination of who's in control. And more importantly, you can see when the market is weakening or when the market is strengthening. So what you have here in this case, right, you see there where the little blue arrow is, you got a delta of 61. So as the market is going up, it's coming up, sort of making this little swing high here, right? You can see the delta is 238, then 123, then 61 at the blue arrow, and then minus 242, minus 115, minus 200. So as you're coming up into the swing high, this little mini swing high, delta's getting weaker, right? Remember, it's the difference between aggressive buyers and aggressive sellers. So if you have a positive delta, it tells you aggressive buyers are in control. If you have a negative delta, it tells you aggressive sellers are in control. But as you're going up into a high, you want to be seeing a more aggressive buying. You want to see the aggressive buying getting stronger if the market's going to continue higher. But as you're going up, it's starting to flatten. It's gone 238 to 123 to 61. And you can see how the market is going sideways. Then it becomes negative 242. Now sellers are in control. You're at your swing high, but sellers are in control. Well, that's not a good sign in the market, right? If sellers are in control, if you're at a swing high, if you trade momentum, right, you're thinking, well, the market's going to go higher. But what's stopping the market is the aggressive sellers. Now the market starts turning aggressive sellers, and it's minus 242. Next is minus 115. You pop up here, you make a new high by a tick, and you still got negative delta. So you're at a new high with still negative delta. What do you think the market's going to do? Do you think it's going to go higher? People are trying to think, oh, I should buy this breakout because we just made a new high by a tick over the previous high. Okay, well, if you're looking at the order flow, specifically in the delta, it's going to keep you off that trade because you can tell that aggressive sellers are in control by looking at the delta. And then what happens? You sort of go sideways a little bit, but you still got the aggressive selling coming in, and boom, the market drops a quick 8 points in the next 5 minutes. That's how you can use delta in your trading. So remember, delta is the net difference between aggressive buyers and aggressive sellers. Now, max delta just deals with the aggressive buying in the bar. And it's going to appear, it's a different number. It'll appear separate from the delta. And what it is, it tells you how strong the aggressive buying was. Okay, so if you see a number, it's always going to be a positive number because it's aggressive buying. So everything, when you have aggressive buying, it registers as +1. So it can never be negative. If it's negative, that will go under min delta. That would be aggressive selling. But when you see a number in the max delta, what that tells you is how strong the delta was at one point. So you can see cases where, um, for example, right here at 1240, the final delta was 61, max delta was 124. So looking at those numbers, what you take away from it is at one point, aggressive buying was 124, but we only settled at 61. So there was some aggressive selling that came in to push it back down. Okay, now the next bar, right here at 1241, had max delta of just 32, but it finished with final delta of minus 200. So it's telling you early in that bar, there was a little bit of aggressive buying, not a whole lot because it is only positive 32, but aggressive sellers took over in that bar and dominated that bar. We closed at minus 242. Now there's times like you can see a little bit earlier, around 1238, max delta was 238, final delta was 238. So we closed on our strongest delta reading in the bar. Now there's going to be, I don't have one here, but there's times where it could be 0. Okay, that's the lowest it could be, meaning at no point were aggressive buyers in control of the bar. Now min delta is the opposite. It shows how strong aggressive selling was in the bar at one point. So you can see here around 1237, you had a min delta of -1. Okay, what does that tell you? It says aggressive selling was never in control of that bar, because -1 is, one contract away from 0, which is, the weakest it could be. But then you can see there's other cases here where, right before this blue arrow down, see min delta was -117. Final delta closed at -115. So we closed almost right on our extreme min delta, meaning aggressive sellers were definitely in control of that bar, especially late in that bar. And it's important to understand, when aggressive buyers or aggressive sellers are in control of a bar, early or late, especially if you're trading on a time-based chart, because you can see in the next bar, it's going to spill over, right? Because, if you're trading on a time-based chart, say a 1-minute chart, well, after 60 seconds, the bar just automatically closes, right? So if you got selling coming in late in that bar, in the last 5 seconds of that bar, it often spills over into the next bar and continues on in the next bar. And you can see on the next bar had a min delta of minus 273, final delta of minus 204, and it's a big red candle down. Okay, so there's ways that you can interpret this delta, which I'm going to get into in a minute, max and min delta, and put together a trading plan. Now, cumulative delta is the total delta up to a point in time from the open. Right? It increases or decreases based on each bar's delta. Actually, sorry, I got the wrong box there, but it's the one that says cum delta underneath. And you can see as it's each delta reading, the next bar, you minus or subtract the final delta from the cumulative delta. So you can see, we're right here at 1240, it had a cumulative delta of 5542. Then the next bar had the final delta of minus 242. So you subtract the minus 242 from the 5542. That gives you a cumulative delta in that bar at 1241 of 5,300. Now there's ways you can use cumulative delta as well to help you understand market direction. Now, advanced order flow traders look at the relationships between max delta and min delta in relation to each other, as well as relation to the market context. Right? You always got to be trading in market context. And what I want to show you is how to use max delta, min delta, and cumulative delta to find an edge. All right, so here we got max delta, min delta relationships. Okay, so you can see, this market comes down and makes a swing low. Now, at the swing low, so you got this big red bar down pushing into the swing low, and you got big negative delta, minus 1053, min delta is minus 1138. Then you hit the swing low, you got positive delta. Early in this bar, min delta was minus 319, but we closed the final delta at positive 373. Max delta was 393. So what happened? Well, internally in this bar, you can see the shift from aggressive selling to aggressive buying. Very strong aggressive selling early. Min delta minus 319, max delta 393. We closed at 373 in the delta. So what's that telling you? Aggressive, there's aggressive selling early, but aggressive buying late. We closed almost on our highest level in aggressive buying in the max delta. Okay, so maybe you're not convinced. Then the next bar after this low, min delta is only minus 3. That's nothing. That's nothing. Max delta was 309, final delta 246. So we're closing, we had very little aggressive selling in that bar so aggressive sellers weren't really in control of that bar at any point. And we're closing up near our max delta number of 309. We're at 246. We're closing a healthy positive delta. Say you're still not convinced. Look at the next bar. It's minus 1 min delta. Max delta is 800. Final delta is 614. So again, aggressive buyers definitely in control. Obviously, you got some buying imbalances in there, which I'll get into later. Again, Mike, I'm still not convinced. This order flow stuff doesn't really jive with me. Okay, then you see the next bar. It's min delta is minus 600. Oh my gosh, Mike, he's got a big negative delta. Max delta is 0. Final delta is 308. Okay, now this is one of the nuances I want to talk about. So what you have here is a green bar. You have this green candle, 4 bars off the low, strong negative delta, no max delta, strong min delta. What's that telling you? People, if you're just looking at the delta by itself, this is again why I talk about taking things in context of the market. People say, well, you got aggressive sellers are in control, but the bar was green. So what's happened? Price action in the bar is positive, delta is negative. Okay, so think about it for a second. Why is the delta negative? Well, you have aggressive selling. Okay, well, who are the aggressive sellers selling to? Well, the passive buyers. Okay, Did the bar close up or down? It closed higher. So as we started rallying up, you've all of a sudden got passive buyers coming in and supporting the market because you have aggressive sellers selling into those bids, but the bids are strong enough to support this market. That's why you have the negative delta. You got minus 608. So at one point, people are like, oh, sell it, sell it. Market's going lower. We're going to break 29. But there's a big buyer stepped into the market and said, not on my watch, not here. They're happy to buy it here around the 31, 32 area. They're supporting that market. All right. So all the aggressive selling that's coming in is being absorbed by the passive buyers. This is a sign of absorption in the market. Even though, the market does tick up, closes higher, you still got the negative delta. People say, oh, you got the negative delta. It's a big negative delta. I don't think we're going higher. This is recognizing what absorption is in the market. Then the next bar at 926, zero min delta, max delta 729, final delta 718. If you're not convinced by this bar, you might as well give up trading. This previous bar here at 925 is a clear sign of absorption. And earlier you saw the aggressive buying coming in. And as you come out of the absorption, you see the aggressive buying take over and the market rallies 10 more points off of that. So that's one of the things you got to understand. Just because you have a negative delta or a positive delta, take it in context with what's happening in the bar, be able to understand the aggressive buying and the aggressive selling to the passive buyers, to the passive sellers. Okay, here's more on the max min delta relationships. Okay, so we hit this new low. Again, all these charts are just from yesterday. Okay, and we're coming into this low. We're selling off, make the new low at 124, 125, 126, another new low. Okay, and as you're coming down, making the low at 923, 924, strong negative delta, no max delta at all, 0 and 0 on those two bars coming into the low, those two red bars coming into the low, all min delta, right? We close at min delta numbers. First one, minus 965, min delta was minus 1008. The next bar, the min delta was minus 969. Final delta was minus 629, so it's a little bit weaker, not much, but a little bit. And then you pair up the low, double bottom here, minus 190. So you didn't have the big, strong, aggressive selling that you had earlier with the minus 1000, minus 969. Then it turns positive delta, 618 max delta. We closed at 583, so we're closing right there around our strongest delta point in the bar. Then the next bar, okay, it's kind of a mix, it's kind of a wash. All right, you get min delta minus 140, max delta 100. Okay, pretty evenly distributed. Final delta 21, which is small. It's, for me, a delta in a bar is around 50 or less. I treat it as neutral in terms of market analysis. Then the next bar, where's the aggressive selling? It's minus 13 only. That's nothing. Max delta is 915. We close at 914 in the delta. Okay, so one contract off our max delta number. So the aggressive buyers are coming in here. Then what happens? It's the market. It goes sideways on you and it tests the low. Minus 400 min delta. Final delta is minus 390. Okay, it's kind of bearish, but we're still a bit higher. Then the next bar, 14 on the delta, which is a neutral number. Again, the internal delta numbers are kind of mixed, 228 versus minus 130. Then as we go sideways again, 201 versus 129 and 239. So again, kind of mixed internally in the max and min delta. Then we get this bar, we test the low. It's minus 785 early in the bar. And I'm thinking I'm long here from 33.24. Oh my gosh, we're trading 2.25. Looking at the min delta in this bar, it's minus 700 at one point. So at one point, it's just all aggressive selling. But what happens? Something changes in the bar. Went from minus 785, you close at minus 77. So you had, imagine what happened, 785 aggressive sellers over aggressive buyers in the bar. But the aggressive buyers came back, wrestled control, to sort of tie it back up at 77, which is kind of a relatively small number. So you went from minus 700 to just 77. So it ate back about 700 contracts. And then the next bar is the money bar, so to speak. Are we going to see more aggressive selling or more aggressive buying? And like I was saying earlier, on time-based charts, especially, since it's based on concept of time, you often see the spillover into the next bar. So you saw some voracious buying late in this bar, all right, as the min delta went from minus 785 and we closed at just 77 in the delta, the buying spilled over into the next bar. And you can see the min delta is only 29, max delta is 761, final delta is 721. So we're closing right near our max delta. So buyers are definitely in control. And then the market finally makes the move in the direction from the 25 area up to the 30 area. So that's how you can use the max and min delta relationships to understand what's happening in the market. Now, the cumulative delta can be used to determine the market's overall strength. So, the way that a lot of traders can use cumulative delta is watch sort of these turning points. This is a very basic way to use it. But you see cumulative delta as we come into this low at 125, 126, delta is negative. Okay. Yeah, that's you expect it to be negative. Usually you expect it to be its strongest negative. But granted, yesterday was unemployment day, so the market's a bit um, all over the place. Then it starts turning positive after the low is made. That's not a sign of a market that really wants to go lower. If you're got a negative delta going into the low, then all of a sudden, boom, it flips right on the low, or a bar or two after, or three after the low. Aggressive buying is coming in. You should be, when you're going into the low, oftentimes it takes a lot of selling pressure to get down to the low, so you're going to be a strong negative delta. If you're at the low and the delta is just kind of around break even, around zero, that's not a good sign. All right. And especially if it can't hold its negativity, so to speak, that's again not a good sign. So we hit our low, we got positive 28 cumulative delta in the next bar, come back down, hit the low, then the next bar positive delta, next bar positive delta, next bar positive delta. What do you think the market's going to be doing? You don't expect the market to keep selling off. You expect the market to start to rally, because what you don't have now, you don't have the aggressive selling at the low of the day. Now, another way people use it is, they compare the cumulative delta where we are at one point earlier to where we are now, especially if we're at a high or low and going sideways. Is it strong or is it weak? This is bonds yesterday. And you can see as we come up, we make the swing high, delta's at 25.38, which, you're at a swing high, you expect a positive delta. You can see how it's positive delta keeps growing, 942, 1,000, 1,300, 1965, 25.38 as you pop up here. Okay, then we go sideways. 1, 2, 3, 4, 5, 6, 7 bars. This is a 5-minute chart, so it's about a half hour, just over a half hour. Cumulative delta, what's it doing? Well, now at this 9 o'clock, cumulative delta is only 2,000. Earlier it was 2,500. We've gone one tick higher than earlier, but mostly just gone sideways. So what's that telling you? Think about it for a second. You're at 2,500 cumulative delta. So earlier you had 2,500 more aggressive buyers than aggressive sellers. Then you hit a high and you go sideways. You're starting, you put in some time. 30 minutes later, you're still at that same level, but your cumulative delta shrank from 2,500 to 2,000. Okay, so what's going to cause that cumulative delta to shrink is aggressive selling. And you can see, obviously, the delta is minus 244, minus 323, minus 224, minus 220. and you had a positive 68, positive 300. But you think about it, right? Accumulation, distribution. You're at your high level. Big traders, they don't want to move the market. So they're distributing, they're slowly distributing over this half-hour period, over 500 contracts net. They're selling it, all right, without trying to move the market too much. Then what happens? The market finally breaks and sells off from, that 182.16 all the way down to, the 182.02 area. But the signs were there in the cumulative delta. As you're going sideways, you could see the distribution going on. All right, because as you're going sideways, you're going to start to think, well, is this market is this just pausing and then going to go higher, or is it pausing and then going to go lower? Reading the delta, cumulative delta, tells you market is most likely going to go lower. Someone's distributing their their position up here. They're getting out of the position, or maybe they're initiating some shorts. Again, you don't know. All you care about is what's happening in the order flow, right? You could make that guesses. Okay, well, I don't see people building up a position here. Instead, I see people lightening up their position or getting short. So cumulative delta, max delta, min delta are data points that give you further insight into the market that you may have overlooked or not noticed, right? If you're not using order flow, you're not going to see it. Now, I want to talk about imbalances because, imbalances is a great tool for traders to understand what's happening in the market. And a lot of traders sort of miss the point on imbalances. So remember on our dome, right? You have aggressive buyers and aggressive sellers trading against each other, against the passive buyers and the passive sellers. And imbalances occur when there are more aggressive buyers versus aggressive sellers in the two-way auction. Okay, so what that means is, here's market's 39 even bid at 39 and a quarter. If one lot trades at 39, but 50 contracts trade at 39 and a quarter, you can say there was a buying imbalance because there's more trading on the offer. There's more aggressive buying going on, so that would be considered a buying imbalance. So while delta is a difference between aggressive buyers and aggressive sellers in a bar, imbalances occur when there are more aggressive buyers versus aggressive sellers in the two-way auction by a ratio of 4-to-1 generally. Some people use 3-to-1, some people use 6-to-1, some people use 10-to-1. But sort of the general ratio that most people use is 4-to-1. I use 4-to-1. Now, not every bar or price level will have an imbalance in the two-way auction. And on an order flow chart, most order flow charts, again, you can customize the colors, but most people use blue and red. Red for selling, blue for buying. And you can see I didn't highlight all of them, but I highlighted, I highlighted a few, so you can just sort of see how it looks like on an order flow chart. So you can see where there's areas of aggressive buying, right off the low of the day, or the low of this move rather. You can see some aggressive buying, 9 against 87, 155 against 715. And you're going to see also sometimes you're going to see selling imbalances in green bars, just as you're going to see buying imbalance in in red bars. You can see here there's a selling imbalance on this green candle off the low, 510 against 115. That's more than a 4-to-1 ratio. If you're using 5-to-1 ratio, it wouldn't show up. So again, 4-to-1 is what most people use, and 4-to-1 is a good starting point for a lot of people. I know some people like to get fancy and use 987-to-1. Honestly, the difference between 987-to-1 and 1,000-to-1, which is 10-to-1, is 13 contracts. I don't think that makes that big a difference in the analysis because you're sort of trying to define it very tightly. Now, most order flow traders understand what imbalances are, why they occur. But now you got to apply them to the market. And stacked imbalances is how most traders apply imbalances. And what a stacked imbalance is when there's 3 or more imbalances stacked neatly on top of each other or below each other. So stacked selling imbalances, you can see here on the left, 167 against 3, 129 against 23, 240 against 0. These are selling, you got 1, 2, 3 selling imbalances all stacked neatly on top of each other. Over here, you have 3 buying imbalances, 1 against 93, 29 against 187, 43 against 791. and they're all stacked neatly on top of each other, right? 1, 2, 3 price levels neatly stacked on top of each other. That's how most traders use imbalances. Um, because having a single imbalance in a bar doesn't necessarily mean anything other than what the liquidity was at that time. But when you start seeing bunches of them in a bar, especially stacked on top of each other, it means something. It means a big order was coming through the market. You either had a big aggressive buyer or a big aggressive seller active in the market at that point. A stop could have been triggered. There's several different meanings in it. And one of the nuances, I'll just give this one to you. I sort of talk about this in my inner circle. It's what I call an overlapping imbalance, right? You got a stack selling imbalance followed by a stack buying imbalance within a certain amount of bars. That's very bullish in this case because you got the stack selling imbalance on the way down, but then buyers came in, stepped up within a certain amount of bars to buy it back, realizing this low is probably going to hold for now, and they're getting aggressive and they're buying it up. This is what I call an overlapping imbalance, and I talk about it in my inner circle, and it's something you can build a trading plan around. You look for them in certain markets, and they're quite nice trades to take. Now, stack selling imbalance again, is very obvious, very optical, right? You can see it. It's very clear. 1, 2, 3 imbalances all stacked neatly on top of each other. And they work. Sometimes they don't work. Here's a stack buying imbalance. Boom, market shot up, and then it came right back down through it. Okay, this was, did it work? Yeah, technically, it went up, but then it quickly came back down through the level. But I want to share with you strategies that work basically. And please note, right, the market doesn't trade in a bubble in the sense that you should look beyond what the bar right in front of you is doing and understand what the market is doing in general. Is the market going up, trending down, going sideways? You got to take everything in market context, right? Just because you have a stacked buying imbalance, where is it occurring? Is the stacked buying imbalance occurring off the low, right? Like here, right? You got a stacked selling imbalance. You had a trend down. Then you got stack selling imbalance. Well, it's probably not going to be very effective because you got to start thinking about what's the capacity for the market to move lower. But the market moved down. Now it's starting to move up, and you see a stack buying imbalance coming. You see a stack aggressive buyers coming in off the low. You got to weight this more than this, just on where it's coming in on the market structure. You got aggressive buying coming in off the low. It's going to be more important than aggressive selling coming in after a protracted move down. What you could be having here is people capitulation, fear of missing out, FOMO coming in. Oh my gosh, we just sold off 10 points. I want to sell it. And then what happens? They sell the low and the market starts rallying. What you want to catch is as you start coming up off the low, is there aggressive buying coming in? Just as you'd look for aggressive selling off a high. So that's why I say take things in context. So what I want to share with you is multiple imbalances. And I just talked about stacked imbalances, which is 3 or more imbalances in a bar stacked neatly on top of each other. But you could have instances where you have 3 or more buying imbalances or selling imbalances in a bar that aren't stacked neatly on top of each other. Okay, they can be spread out in a bar. You could have 2, then a normal price level with normal order flow, and then another imbalance, right? That's what I call a multiple imbalance. And as this was something that was very important to me, and I had it in my software for years already. And there's people telling me, I just look for these multiple imbalances at certain points in the market, at swing highs or swing lows, and just trade it. So, earlier I was showing you this example, right? You had the stack buying imbalance. The market went up, then came right back down. But earlier, you see this bar, it's got the purple box around it. You have 4 buying imbalances in here. 4 blue numbers, 1 against 19, 0 against 6, 0 against 28, 8 against 44. This is a bar with multiple imbalances. So where would you rather get long? Here at 117.94 or up here at 118.04? It's allowing you to get into this trade. It's recognizing the aggressive buyers earlier than just looking for the stacked imbalance. So you get in a full 10 points. You could catch this move. This is the move you want, right? You don't want the second move with the stacked imbalance because it only goes up, then immediately comes back down. But even if you're buying it here at 94, at 95, even if you ride it all the way up, it comes back down. It only comes back down to the 95 area before it starts going back up to the 118 area. You know, multiple imbalances are going to help you get into trades a lot earlier. So this, as you can see here, right, the multiple imbalances in this bar, right? That's what you want to see. Now, here's a move up, right? You've got multiple imbalances right off the swing low, right? You go up, you pull back a little bit, more multiple imbalances, go back up, pull back down, more multiple imbalances. Again, this is just yesterday afternoon in the E-minis. It occurs over and over in the markets, right? And if you're just looking for stacked imbalances, you don't see any on this chart, right? Because they're spread out in a bar. So, you have to not rethink imbalances. You just got to add, okay, common sense. Well, just because you have imbalances in a bar that are not stacked on top of each other doesn't mean they're not important. They are important. And you can see here how it's giving you 1, 2, 3 trades as the market is rallying up off the low. Now here, the market was going sideways, right? This is a bond. Okay, this is yesterday. It's a 5-minute chart. You can see it's just going sideways and boom, aggressive selling coming in. If you trade breakouts, people say, well, I don't need order flow for that. I could trade the breakout. Well, yeah. Well, wouldn't you want to know if there's aggressive selling in the bar? And we sell off from, the 182.08, 09 area all the way down, to new lows at 181.24. Here you go, right? More multiple imbalances, right? This is E-minis, right? Market's going sideways. If you're only looking for stacked imbalances, you just miss this move because there's no stacked imbalances until later, right? You could see up here earlier around the 33, 36 area, you got 2 bars with multiple imbalances in them, right? Then the market sells off, and then down here at 33, 32, you got multiple imbalances, a stacked imbalance rather, but the move already happened, right? Where would you rather be short from? The 36 area or the 32 area? Yeah, the market, the second imbalance went down from, the 31 area down to the 29 area. Okay, that's 2 points. You probably would have expected it to keep going lower. If you didn't cover it, the market came right back up through your stacked imbalance and probably would have stopped you out. But if you're short from 36, you're getting into the trade a heck of a lot earlier, right? You're catching that big move down rather than catching the small move down a little bit later. And for people that like to think the markets are fractal, look at this. This is an E-mini 1-minute chart. You got this big sideways action to the left before you got the stack selling, the multiple selling imbalance, right? Earlier, bonds, same thing. Market's going sideways here, and then boom, multiple selling imbalances as the market breaks down. Just very similar that chart to this chart. This one's an E-mini 1-minute chart. This is a bond 5-minute chart. The markets react the same way because the big traders trade the same way. They can't hide their size. If they want to get a position on, they got to start being aggressive at some point. They can only passively sell or passively buy a certain amount before the market starts moving. But once the market starts moving, they got to get aggressive. Now, multiple imbalances doesn't mean it has to be 3 or more imbalances a bar. Right? You can start at 2. Right? If say you trade, I don't know, some people trade 100 tick chart. You could look for 2 imbalances in a bar. Or say you have bars, say you trade NASDAQ, right? You could use 4 because NASDAQ can cover a lot of price levels. So for example, here's a E-mini. This is a 4 range chart, right? So it's a range-based chart. So you only get 5 price levels in a bar. But you could see here, right? Boom, to the left, right? 2 imbalances, market sells off, hits the swing low, market starts rallying up. 1, 2, 3 bars with multiple, 2, these are considered multiple buying imbalances because it's set to 2 imbalances. 1, 2, 1, 2, 1, 2. Then you got 3 here, okay? Then another 2. Market goes sideways, starts going sideways. Then you see aggressive selling coming in to the right. You see 2 bars with 2 selling imbalances as the market goes down. So you can see it's almost, doesn't always pick these exact turning points like that, but it's pretty good. Here's again, E-minis. These are all just charts from yesterday. At the swing low, market goes up on the left. They're at 151, rallies up 3 points, comes back down, boom, rotates to 29.5, rotates back up to 33, comes back down to 31, multiple imbalances as the market goes back up. So you could just, there's so many ways you can apply multiple imbalances to your trading. Now, if you want to be, a bit more stricter, you can say, well, I just want to see bars with 4 more imbalances in them. Now you'll notice, do you see any stacked imbalances here? No. Any stacked imbalances there? No. So if you're looking only for stacked imbalances, you're missing a lot of trading going on, right? You're missing a lot of trading, no stacked imbalances there. So this is a bar, it's an 8-range chart on the E-minis with only with 4 imbalances or more. And you can see here, it gives you this nice trade right at 1227. Markets, it's a nice 5-point move up from the 34 area all the way up to the 40 area. It's just, you don't see a lot of, depending on the chart, if you set your imbalance levels to 4 or 5, you might not see a lot, but the ones that you see can be dynamite. Here, yesterday, E-minis again, got our swing high, start coming off, bar with strong aggressive selling, 4 selling imbalances, boom. Again, the market makes its move from, the 40 area down to 35. It's beautiful sometimes. So as you just saw, there are more ways to look at imbalances in a bar beyond just stacked imbalances. So, look at multiple imbalances. My order flows trader software will highlight them to you. If you're not using my software, say you got another software that has a footprint chart, you just got to use your eyes. I like to have the software highlight things to me, and the order flows trader does. Now, lastly, I want to talk about short-term value, how to determine it and how to trade it. So what's value, right? Well, think of it as what something's worth, right? That's why gold is going up, because it's a storage of value. Once you know what it's worth, then you know if its value is going up or its value is going down. And understanding where value is in where the market is trading in relation to value is going to help you when you're confused on what the market is doing. Sometimes, honestly, sometimes we get in positions and it's not really working out. We feel a little bit confused. This market should go higher, but it's not going higher, or it should go lower, but it's not really going lower. Well, now you got to take a step back and think of where value is in the market. Order flow has a thing called point of control, and it's the price level in the bar with the most volume. When you see several point of controls at the same level over consecutive bars, the market is often defining value. Okay, so first of all, point of control, every bar has one. And on a footprint chart, it's going to be, there'll be like a rectangle around that price level. But when you see points of control sort of lining up in an area, over 3 bars or more at the same price level, the market is sort of defining value in that area, because over time people are trading at that level a lot of volume. All right, and that's important to understand, because when there's a lot of volume trading at a specific level, that means traders are happy to transact at that level. It's a fair price to them. That's where the value is right now in the market in the short term. But you got to watch what happens as you start moving outside of that bunch POC. Where you got here, like I drew the blue box around these 3 bars that have POCs right at the same level. Okay, that's fine. Well, maybe I was long from earlier, then the market's just going sideways. Well, what do I do? Well, I see, oh my gosh, we're putting in bars with the same point of control. Okay, so we're going sideways. Then you got to watch what's happened as you start moving out of that area, that sideways activity. And then you can see the next bar, it's got a higher point of control, right? The one right above the blue arrow. So the point of control is now higher than it was earlier when you put the 3 in. The next bar is higher. Next bar comes back down to the previous one. Then the next bars are higher. So, you can feel confident in your position that we are trading, starting to put in value areas, right? The points of control, think of them as value in that bar. And when you got several point of controls at the same price, it's putting in a bigger value area. But as each bar happens, you got a higher value area. And again, here, right, you're sort of thinking, maybe you're long from earlier and it's just going sideways on you. It's frustrating. Sometimes we get into these trades that frustrate us. And then you can see here in this blue box, right, I've got 4 bars. 3 of them have the same price level, the same point of control. So it's putting in this value area there. Then obviously we break down through it, which is not a good sign, a lower point of control. At this point, if you are long and you got to stop, somewhere down here around 33, 34, you just got to get out, right? Don't expect the market to sort of turn around and start rallying, because traders found an area up here. They're happy to trade, happy to transact. Then the market comes off that area and starts putting in lower points of control. That's not a good sign because now you're putting in lower value to the value that you just had earlier. Now, another way to use point of controls to help understand what the market is doing is watching how they move. In a trend up, point of controls should migrate higher. In a trend down, point of controls should migrate lower. And this is especially important as the market starts breaking out of sideways activity. So you can see here, right, you got market sort of going sideways up here on the top left, and then lower point of control on this big red bar down, the blue bar, or sorry, the green bar got a lower point of control. The next red bar, lower point of control. Next red bar, lower point of control. Point of controls are going lower. That's what you expect on a market trending down, right? So again, if you're in a position and you start seeing lower points of control, if you're short, that's good. If you're long and you start seeing bars put in lower points of control, that's not a good sign. The market is finding lower value over each bar. Right. So again, market's sort of going sideways in here, chop, 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 chop. And then you start seeing the methodical move down in points of control at 105. Point of controls up here, next bar lower, next red bar lower, next red bar lower, next red bar lower. After I start seeing 3 points of control move in a direction, if it's not in the direction that I'm positioned in, I start to reconsider being in that position. So if I'm long, right, say I'm long from whatever 31, then I start seeing a point of control at 33, then 32 and a half, then 31 and a half. I see 3 lower points of controls. That's not a good sign of that position. I know that I should really consider cutting it. Chances are I'm probably going to just go march right down to my stop. And in this case, the market marched down. And if you had a stop down here at 29, you would have been stopped out. But if you can read what's happening in the order flow as the points of control are migrating lower, you get out, 31, 31 and a half, 30 and a half, rather than taking the full loss at 29, and just wait for a better opportunity. Everyone always talks about cutting your losses short, but they don't really show you how to do that. By reading the order flow, by reading the points of control, what's it doing? By reading the delta, what's that doing? That's going to help you cut your losses short because you're going to recognize the market is not doing what you expected it to do based off your analysis. All right, you could analyze the shit out of it, but the market's going to do what it's going to do. And no analysis you do is going to make the market do what you want it to do, right? So you got to read what's happening in the market after you get into a trade. So here, the market's rallying, right? Points of controls are rallying up, right? You got the 3, right? You got big 3 points of controls right at the same level. Then you start breaking out to the upside. You got multiple buying imbalances. Obviously, you got nice positive delta, nice strong max delta. Everything you want to see on a move going up. You got the stacked imbalance earlier, points of control, higher, 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 right? This is everything, putting it together, right? Values moving higher. You got the multiple imbalances, right? You have a stacked imbalance down here at 927 and 30 seconds. Okay, that's nice. But earlier you had the bar at 927 with multiple imbalances. Okay, so again, multiple imbalances often precede stacked imbalances, right? That's going to give you an edge over other traders. You see the points of control migrating higher after going sideways between 929 and 930. You see the positive delta appearing there, and you see max delta and min delta relationships, right? You don't see very strong min delta, so the aggressive selling is not that strong in there. So once you start putting together the different parts of order flow, the market just starts to make sense. and so many people have written to me afterwards saying, you know what, you know, after following the order flow, understanding what I'm looking at, I really understand the markets now, and that's what trading is all about, right? To be successful in the markets, you have to understand why something is happening, why a move is happening, why the move is weakening, why the move is strengthening. And order flow helps you understand all that information and understand when the market is in its different phases, right? And order flow analysis provides the trader the information they need to gain an edge over other traders. A lot of this information you're not going to see on a normal bar chart, okay? So you want to see and understand what's happening in the market that other traders don't see, right? That other traders aren't looking at. So hopefully you can see how powerful order flow analysis is, right? You don't want to overcomplicate trading. Traders like to overcomplicate things. Throw different indicators at the market and hopefully something sticks, right? Just learn to trade. Trade what's happening right in front of you, right? And there's the famous saying. I always laugh when when I was younger. My dad told me this saying. The famous English actor Sir John Gielgud was in a movie with Dustin Hoffman. Dustin Hoffman's a method actor, right? He's going through all this thing. Oh, I got to get into the character and I got to do all this stuff. And Sir John Gielgud says, well, why don't you just act? And it's the same thing with traders, right? Oh, I got to add this indicator. I got to trade, I got to put this indicator on. I got to put this on. Why don't you just trade the market? Just trade. It's the same thing. So if you found this presentation helpful, and hopefully you did, you'll like my order flows trader software package, which makes order flow analysis easy. So, hopefully you're ready to add order flow analysis to your trading. So there's two ways to do it. One, the first way is try and learn order flow on your own. Okay, you can spend years of looking at a screen trying to figure out order flow. More importantly, you're going to waste years of time and money trading, thinking you understand it when you really don't understand it. I was very fortunate. I worked in big commodity trading firms. I've worked for banks. So I was daily exposed to many different traders and different trading mentalities. I was able to take things, but in conversations with traders, what works for them, just talking about markets and analysis. And I've cultivated my method of trading over many years by dealing with successful traders, right? So the second way is that way, get the education and software from a trader who has successfully traded order flow at the highest level for decades. I've traded professionally for, 25 years, okay? So I know what I'm doing. I'm confident in what I'm doing. This is how I support myself. Skip the massive trading losses, skip the wasted time, get the proper education. Not only that, get the proper software, right? Order flow is the most current information available to a trader. It's not some indicator, it's the market. Right? You got to trade the market. Don't trade an indicator. Order flow is not based on pivot levels. It's not Fibonacci. It's not based on Elliott wave. It's not based on MACD. It's not based on VWAP or anything like that. Your order flow is what's trading on the bid, what's traded on the offer. Order flow is the market. So the order flow is trader. Now it runs on NinjaTrader 8. It doesn't run on Trade of 8. It doesn't run on TradeStation. It runs on NinjaTrader 8. It'll run on the free version as well. I got a lot of people that use the free version and just use a different trading front end to enter their orders. And it's the volume footprint chart that you saw in this presentation, right? The charts are generated from the order flows trader software. So you can see like the multiple imbalances, you can see the points of control, you can see all that information. You're also going to get my chart template. Normally I sell this for $8.99, okay? But I realize having order flow software is one thing. You got to know how to use it. So I don't just give you the software and send you on your way. I provide a lot of education on how to trade with order flow. And each week I do a private live group training session for users. If you can't attend, you could watch the recording. Now I got over 80 recordings. Some people go charge extra for this. It's free. I provide it for free. You can ask questions, say you're stuck on something, say you want to look at a particular market. Every Tuesday night, I've been on vacation for the last 2 weeks, so I haven't had the sessions, but I'm starting up again on the 11th. And again, it's free. It's a resource for you. It's a resource to reach out to me. Say, oh, Mike, you missed my email. Sometimes emails go to spam. You can ask your question in this trading room, and it's every Tuesday night, 7 p.m. to about 8 p.m. Central Time. Okay, and it's free. It's a free resource for you. You can watch the recordings if you can't attend. I will also give you the order flows trading course, which is the first course I did on order flow trading. And normally I sell it for $297, and people buy it every day on my website for $297. You're gonna get it for free. But I realize, a lot of people sort of understand the basics of order flow and they want more advanced stuff. So I'm gonna give you also access to my order flow inner circle series. This is the videos. There's 56 videos on advanced order flow tricks, tips, analysis, and nuances. Normally I sell this video collection by itself for almost $500, $497. I'm gonna give you that also for free. So when you add up the software, all the different trainings, it's comes out to about $1,700, $1,693. Okay, but think of it this way. It's like skipping the line at Disney World, right? Trying to figure out order flow by yourself is like standing in line trying to get into Disney World or trying to get into that ride. What you want to do is you want Mickey Mouse to come out, not that I'm Mickey Mouse, you want Mickey Mouse to come out and say, hey, hey, Joe, come to the front of the line, come over to our secret entrance, so to speak, and, fast track yourself, so to speak. And as a special bonus for Investors Expo visitors rather, I'll give you access to my order flow playbook, right? Which is a course I did on order flow. It's a great course. There's a lot of great trade setups in there that I discuss. I'll give you that for free. Normally I sell it for $297. So you're pushing already close to $2,000, and that's not even including what other people charge for like a weekly group training. But you're not going to pay that, right? I don't want you to pay so much, because money's tight for a lot of people, but other people that have bought my software said this is what they say about it. Your order flow software is remarkably helpful. I can clearly see now what is really happening in the market, like who's in control of the market on a very specific time and who's getting weaker as well. Another guy writes, order flow is the path forward, and Mike's experience and explanation, and it clicks. Okay, so think about it, right? You want to be successful in trading, you got to figure out how you're going to get there. Oftentimes, you're not going to get there by yourself, right? You're going to need some education. So for a one-time payment of $675, there's no monthly payments or any other payment in the future. Of course, you're going to need to pay your data fees for the exchange data, the live data, NinjaTrader fees if you have a paid version of NinjaTrader, but the software will work on the free version. Just go to orderflows.com/oft2.html. Okay, and it's going to take you to this page. Just scroll down to the bottom of the page. This is the page at orderflows.com/oft2. It's going to take you to this button. Just click buy now. I want this. Right? It's going to take you to PayPal. Okay, I don't process your card. PayPal does. Okay, if you have PayPal, most people have PayPal. The button right below it says pay with a debit or credit card. That will allow you to pay without having a PayPal account. Now, if you want my book, okay, you can see here, go to orderflows.com/book.html, and you'll have to enter your name and email address, okay? Then after you hit submit, it will take you directly to the download page that you can download the book from, okay? It'll pop up as a new window, so it's not gonna pop up on the same window that you enter your information. And you can save it to your computer, print it up, save it to your handphone, save it to your tablet, whatever. It's there for you as a resource. So, to get started, you got to get started. With anything in life, you got to take action. That's the worst thing is, people. I see a lot of people come to me, Mike. I want to be a trader. Okay, well, what are you doing to start trading? And they have no plan. They have no what do you want to call it? No way to become successful. They just think that they're going to open up an account and start trading, and money's just going to magically fall from the sky. No, it's not. You got to take action. You got to learn what you want to do in life, right? We're all not going to be a doctor and just also, oh, I'm going to read a book on becoming a doctor and become a doctor the next week. No, you got to apply yourself. You got to learn how to become, a doctor. Trading, you got to learn how to read the markets. You got to learn to understand what's happening in the markets. So again, you've got to take action in life. Honestly, I, I s- I probably shouldn't say this, but the biggest failures in life are the people that don't take action. in life. And it's sad because, I know a lot of, I have friends that, are just like, yeah, Mike, I want to do what you're doing. I want to trade like you. But then, they don't do anything to take that next step forward, right? I say, yeah, sure, come on, let's work together. Oh, I'm busy that weekend, or, um, I can't, I got to get another computer, or I got to do this. Well, gosh, you can buy computers are so cheap nowadays. It's so easy to get a computer. There's ways to do things cheaply, and everyone, they stop making excuses in life, right? You got to take action and do things. There's a phrase, imperfect action. I'd rather you take imperfect action, at least get started doing something, than not take action doing something. All right. And, so you can become successful as you want to be, right? But the choice is yours. So, um, anyway, go to my website, orderflows.com/off2. If you want to learn a lot about order flow, go to my YouTube channel, subscribe to my YouTube channel. I've got, 250 some videos on order flow up there. You could learn a lot. It's the easiest way and the free way to learn how to read order flow. Watch what I have out there already for free. Decide for yourself if order flow is for you. So again, um, if you're interested, go to orderflows.com and get started. Take action. Take charge of your life. So I'm going to end it there. Everyone that stuck around, thank you for coming in on Saturday morning. I realize it's a weekend, but hopefully you come away and you can learn a lot about order flow. So have a great weekend, everybody, and I'll see you guys on the inside. Bye bye.